This is the headline that's garnering all the attention today.
All the evidence shows there's an investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Lucian Gindorf, and this is A Steward's View. So good to be back with you. For this week's economic and market update, please do visit astewardsview.com/blog. Again, astewardsview.com/blog. Today on ASV, we'll take a look at the second quarter of 2026 from an economic view, the implications for long-term investors, and the decision points associated. As usual, we'll work to integrate knowledge and wisdom, those two things, those two key ingredients needed for excellent stewardship. Our goal is to elevate and enhance your decisions, including with your professional advisors. So before we get going, let's take a moment. Let's examine our work in the context of God's word about stewardship. In Luke 16:11, we hear, "If then you have not been faithful in the unrighteous wealth, who will entrust to you the true riches?" I'll repeat, "If then you have not been faithful in the unrighteous wealth, who will entrust to you the true riches?" So, a very rich challenge here from Jesus. He's talking about unrighteous wealth, or the mammon of unrighteousness, which in the Bible is a reference to earthly money or material possessions. Okay, so Jesus coined this term in the Gospel of Luke to highlight that worldly wealth is intrinsically flawed, untrustworthy, and prone to becoming an idol. So we heard last week on ASV about in our giving and the art and science of giving series, where Paul Larson was making a comment about wealth not being either good or bad. It's morally neutral. That can still be true here, but we're hearing more specifically about the risk and the caution that we need to have in how we deal with wealth, right? And looking at it as just that, as a tool, and not as something to be sought after for its own sake or to be greedy about, okay? And so very interesting follow-up there in Luke 16:11 from last week's conversation in our giving series. But moving forward, we can talk more about the uses of wealth in this program. That was the core purpose of our giving series, as well as some legacy conversations we've had, some estate planning conversations. I mean, really, the dynamic puzzle box is our financial picture, right? And that's what we want to level up decision making about, right? And what is that puzzle box, Lucian? I know you weren't here for that killer episode. We talked about the four corners of the puzzle box. It was and is what you own, what you owe, what's coming in, and what's going out. Okay, so those four corners comprise our balance sheet and our cash flow. Whether you're a business, you're a trust, you're an individual, a family. Okay, so any entity has that. And how is that stewarded in the context of stewarding a life, right? Stewarding everything that we have. And so I just wanted to offer this mention from Jesus about unrighteous wealth and how important it is. Paul Larson talking about being careful with what we dare keep, not, giving and then saying, oh, well, I can now do whatever I want. But what is it I did with what I kept? And that's exactly what Jesus is saying here. So, in fact, Paul's saying exactly what Jesus was saying, if we're clear. But, if we don't, who will entrust to us the true riches? And what are those true riches? So let's pause there. Let's just consider for a moment what true riches are about. And we'll move forward into our core content. These verses, this verse fits with a steward's view in a big way. That idea is that we're stewards or managers, not the ultimate owner of our financial picture, not the master of our own destiny, as is commonly thought. Our financial resources then are ours for a short time, and our decisions can come from that perspective. So with this kind of wisdom in mind, let's take a look at our core content for today. Last quarter, in the U.S., in the global economic picture, we had a lot of resilience. And I'm going to go through some points that I think are pointed. They're important where long-term investors are concerned. I'm going to kind of go from the very broad to the very specific in a pretty rapid way. So if you're not new to a steward's view, you would consider this to be one of our more, weighty episodes, maybe a little bit longer as well. But thank goodness you can hit rewind on any of our major platforms and catch whatever you missed. So here we go. The U.S. economic picture remains resilient in 2026. That is second quarter. We just closed April 1st to June 30th, 2026, with a projected 1.5 to 2.2 GDP growth. Okay, we'll have that number very soon, despite an oil price and supply shock tied to Middle East tensions. Global growth is slowing, estimated at 3% as inflation resurges, 4.7% amid energy shocks and shifting trade policies. Central banks are holding interest rates steady. So in the U.S., inflation and policy goes like this. Core inflation and PCE estimates have climbed to about 3.3, 3.4%. This is sticky. And because of that stickiness or that kind of continuation of inflation hanging around, that's what we mean by sticky, the rate cut expectations have been dialed back, with markets pricing in the possibility of rate hikes over further cuts. Okay, so again, we're on the very high level here. U.S. employment and markets, the labor market has demonstrated stability with artificial intelligence and tech capital expenditures driving continuous business investment. However, U.S. markets face volatility stemmed from temporary 10% blanket tariffs and geopolitical developments. Okay, so there we are in the tariffs conversation again. That's kind of gotten, not ignored, but probably overwhelmed by some other geopolitical headlines of late, really since the Iran conflict with the U.S.-Iran conflict began back in late February, early March 2026. Globally, growth forecasts for regions like Europe at 1.1% and China at 4.4% have been trimmed as global economies navigate mounting inflationary pressures. So if we want to look more at changing monetary policy, we can take a look at the Federal Reserve economic outlook, or we can track broad economic data trends. And, one place I go for that. And I'll put all of this up on stewardsview.com by tonight on the blog post for the week. But we can go to JP Morgan's mid-year review. That's an excellent resource. And then I'll list a number of other references you can take a look at. What I'd like to do now is take a little bit more of a specific dive into more of a market or investor or long-term investor-oriented bit of content from Morningstar. And they published their Markets Observer recently from 2026 Q2. And there are 1, 2, 3, 4, looks like 8 names associated with this publication. It's very well done, very broad, very comprehensive. So I'm a fan of Morningstar for a number of reasons, but I'll say it this way, that they do a good job of maintaining independence, right? So not being affiliated with any particular institution, right? They have their own sort of research and analysis powerhouse going that other institutions pay into. And they've got some amazing people that put out, great thought leadership as it relates to long-term investment. Okay. So they do blend economic and investment concepts. And so I like that as well. So here we go. This is from Morningstar, and I'll also put this up on stewardsview.com. I'm going to kind of pick and choose through this what is maybe most pointed. So in general, when we talk about kind of the summary of what happened with the markets in Q2, poor stock performance in the first quarter was, and I'm going to quote a lot of this right from the analysts that and researchers that built this publication, because I think they've been so concise. But with that, Q1 poor stock performance was there, and primarily driven by a sharp escalation in geopolitical tensions. Okay, no surprise. Following the outbreak of the Iran war, which triggered a massive spike in oil prices and renewed inflation fears. Investors also shifted away from mega caps, and so now we're talking again about Q1, amid growing artificial intelligence uncertainty. Rising yields held bonds back to, although the Morningstar U.S. Core Bond Index posted a marginal gain thanks to January and February's strong returns. Okay, so that's sort of the backdrop for Q2, looking at, beginning the quarter. Okay, so gold, we got into the quarter, gold reached a new high. So we're still in the first quarter. Gold reached a new high in January before retreating in March. The escalation of conflict in Iran served as primary catalyst for crude oil prices, which nearly doubled in the course of the first quarter and is now more expensive than 78% of prior observations. Oh boy. So this conflict helps stabilize the U.S. dollar after it fell for much of 2025. That's also worth mentioning. I'm not going to try to hit everything said here, but stocks have remained in an expansion phase despite the broad pullback in March as we entered Q2, bringing the current expansion to 27 months. U.S. large cap stocks have risen 28.9% annualized since 2022's downturn, or 77% total, 77.2% total. How about that? So if I invested $1 or any amount, and I'm just going to insert a date here, the second half of 2022, July 1st, I'd have approximately 77% more in my account right now. And more recently, and that's large caps, this is large companies. More recently, small companies outperformed large companies in the first quarter of 2026. And that's as AI and geopolitical uncertainty weighed on some of the market's larger companies. Okay, so major asset classes the last 12 months. We look at commodities gained a robust 32% trailing in the 12 months ended March 2026, propelled by a dramatic surge in oil prices stemming from the Iranian conflict. Emerging market stocks suffered in March as investors ditched risky assets. Developed markets continued to outperform U.S. stocks, though neither was insulated from March's broad decline. Even U.S. bonds suffered, bringing the conservative run of performance to an end in March. Okay, so we're still on kind of the Q1 backdrop here. Energy surged 37% in Q1 2026 as the conflict got going and the Strait of Hormuz closure started to happen. There were various sectors like consumer cyclical, financial services, and technology. They were all down around 9% that first quarter or towards the end of it, reflecting continued concerns over AI competition and spend. Defensive sectors did well in the first quarter of 2026 with utilities, consumer defensive, and healthcare all positive. The U.S. market was down 4.2% in the quarter, but it still gained 17.9% over the past year. Wow. So, the March downturn that we've talked about that was fairly broad as we're hearing about here and hopefully remembering a little bit is just to say, it was quite a drop in a broad way, and yet we were still looking at a 17.9% gain from the same point the year before. So lots of strength in terms of asset prices moving higher during the trailing 12 months that ended March. Internationally, stocks were mixed in the first quarter despite a strong last year. Latin America performed exceptionally well, in large part thanks to Brazil. Eastern European emerging markets as well did great, up 3.3% in the quarter and 28.9% for the past year. Europe, ex-UK, did the worst among all foreign stock regions, posting a loss of 4.2% for the past 3 months on Iran war worries. Despite mixed recent results, international markets have fared quite well over the past year due to several factors, including a weakened U.S. dollar. So a lot there with our backdrop for Q1 going into Q2. I'm going to kind of set aside some of the more technical points associated, but that's kind of the big picture of how markets were positioned as we entered the quarter. I'm going to go into kind of where we are economically now as we peer and have closed out 2026 Q2. Let me see if I can find it. All right. So towards the end, if you're going to log in at stewardsview.com and look at the blog post for tonight, you can just take a look and see this in page 36. It's called Economic Indicators. And so this is where we kind of get into the bigger picture. The oil price shock, along with lingering tariff prices impact, will push up inflation significantly in 2026 and weigh on gross domestic product growth. Any waning of the AI boom also poses a downside risk for GDP growth in the near term, but we expect growth to reaccelerate over 2028 to 30 as monetary easing kicks in. Inflation should converge back near the Fed's 2% target once the oil and tariff shocks fade. So that's good news expected. But monetary policy is expected to be more restrictive to combat oil price shock. Markets expect that for central bank policy rates moving upward due to the oil price shock. And so as of year end 2025, futures markets have been pricing that in as about 0.5% in federal funds rate cuts in 2026. But now they're pricing in 0 cuts. We heard that earlier in this episode. So for the Bank of England and European central bank markets are pricing in rate hikes in 2026. So, and then there's just some commentary here, resuming cuts later, right? All of 2027 and forward is still expected. Some inflation stickiness even, was there before the oil price shock. So now it's really there. Okay, that's another summary point. And we see AI fueling tech investment boom in the U.S. That happened through second quarter. That's part of this commentary as well. So there was a lot more here, really, as I look through this about Q1 being, sort of the backdrop to what happened more than what actually happened in Q2. So no criticism to Morningstar, but I'd like to hear more about Q2. We did talk about that from a high level earlier. So thank goodness for that. One other thing I want to mention is an article I pulled up earlier. I thought this was very interesting. This is someone I follow in Barron's, Martin Bicardix, and I've mentioned him before. He published this it would have been the 13th, so today and just early afternoon today. And he makes reference to Morgan Stanley's Mike Wilson, the bank's chief U.S. equity strategist, talking about second quarter earnings season. Okay, so we start to see a lot of price movements in equities in particular based on earnings as we start to get those figures here soon. But tech giants and their massive spending on artificial intelligence have powered most of the market's gains this year. Okay, well, no surprise. But here's what I think is really neat when this article is quoting Mike Wilson. Okay, and this is an actual quote. Wilson says, "We expect the broadening to continue, driven by earnings resiliency from the median stock in the S&P 1500. He wrote, published on Monday. That's today. The index, which combines the standard S&P 500 with mid-cap and small-cap CapEx trackers, has risen just over 11% this year compared to 10.7% for the benchmark. So in other words, large, medium, and small companies are all moving higher together, right? And so when we get to earnings season for Q2, which we're about to see a lot of, we've already got this broad upward move in equities, right? In stocks, large, medium, and small, okay? And so broad that it's actually outpaced the S&P 500 large companies only by more than 0.5% since mid-May. So, that quote unquote S&P 1500 is now delivering double-digit earnings growth, which is the strongest since COVID. So, this is very encouraging. The Atlanta, one more point he makes in the article. This is the article's author now, not Mike Wilson. The Atlanta Fed's GDP Now tracker did show a slowing economic growth in second quarter to about 1.3 to 2.1%, and quarter over quarter. So I'm not discouraged by that by any means. It's not always everybody wants a 3% number. If I look back and we could be through all of this in the first half and be talking about a 2% number, I personally think that would be an excellent accomplishment. So there are high expectations here, a strong economic backdrop. The labor market has stayed strong. Inflation has stayed sticky. Equities have continued an upward momentum. And coming out of first quarter, as we dove deep there with Morningstar, there was a lot of uncertainty over this Iran conflict, and investors were nervous, skittish, selling risk assets, and we saw prices come down in equities, but we didn't see, the big picture economic pieces start to fall apart, right? We saw the job market stay strong. We saw inflation stay, around, but not, it rose. I wouldn't call it a spike. That's my opinion. But then we got through the quarter. Now we'll see how companies did as it relates to earnings. So all in all, when I look around and I look at jobs figures, leading, concurrent, lagging, I look at equity prices, I look at the bond market, I look at how we're doing with yields, I look at the Fed's considerations, all of these things. We have a very steady picture going for long-term investors. So what is the action to take? And this is kind of anticlimactic, if I may say, but the biggest thing you can do at the end of a quarter is evaluate what did well. Okay, gold maybe made very little comeback, right? So you may have a position in metals that is still down for the year. Okay, maybe you want to refill that position, right? If you're rebalancing. Equities have done well broadly overall in the second quarter. Maybe we want to go ahead and, Lucian, I caught that yawn. Be careful over there, right? I know this is, not exactly the fun part, but come on. So we get the broad equity increases going. Let's take a look at what did the best, and maybe let's sell some of those pieces off at the end of this quarter, or right now that we've closed the quarter, and then reinvest in places like gold or the riskier areas of the markets that we heard about that had sold off, like emerging markets. Okay. So those are some thoughts on how you can respond. I normally back into, and I will not fail to do it again here, the idea of aggregation. So when you locate assets in multiple accounts across your portfolio, first of all, the account types and the asset types in those accounts as it relates to good tax planning is important. But now we're talking about the movement of asset prices within those accounts. Okay. So I realize you can't just pull money from one tax type account to another tax type account when you're doing this rebalance, but we can be thoughtful about how do we do this overall rebalance across accounts, right? And to do that, to do the good tax planning, to do the good rebalancing, to take advantage of what the markets have offered, right? To clip some gains where strong equity positions have won, to reinvest in some of the weaker areas, those things, you've got to be aggregating. So I'll encourage you there with your advisors. Make sure you've got a way to aggregate. I encourage you to do it independently. I will say again, if you want to visit our sponsor's website at fideradvice.com, FIDERE advice.com, and go to Fusion. That's all over the homepage. Just send in a message and sign up for Fusion. We'll gladly get you a free login to our aggregation system. It doesn't cost you anything. There's no advisory contract. and we don't track your activity. So it's a very nice way to get a report, to get a view every day, and a quarterly report with some comments from me and others that'll help you take advantage of some of these moves when they happen. Okay. So as for the plan overall, doing the rebalance in support of a financial plan is the important thing, right? Whatever's done well at the end of a quarter, clipping that, whatever hasn't done as well, reinvesting in that, provided you've got, if there's active management, you've still got a good team. Okay. Let's make that reinvestment happen, right? It's a sort of a natural way of systematically, I'll call it a systematic way of, selling high and buying low. Okay. So that's the message, but do it in an aggregate way, right? Because we don't want to miss something, right? Oh, the account we forgot about that's sitting, great Aunt Susie gave us an asset once upon a time, or one of us received this inheritance and it's sitting off the radar. Well, let's bring it in. Let's look at how that fits and what's going on with it and its impact on the rest of the portfolio. And by the way, do all the pieces of the portfolio like each other? We can actually do that, right? We can do a correlation analysis. So I would encourage you to ask for that. If this is something that you're going into Fusion or other places, ask for a correlation matrix and find out what is it that is happening with the happiness of the assets that I'm invested in across accounts, with one another. Okay. So those are thoughts on how you can take advantage of any moves, no matter what quarter it is. Okay. But this was a very interesting second quarter because we had such broad strength in equity moves, despite the geopolitical context in these sometimes overwhelming headlines about what's happening with the military situation and the conflict between the U.S. and Iran. So those are thoughts. I can't, add a lot to this episode that isn't already going to be posted tonight. So I'll pause there, but I hope this has been helpful. If there's anything here you want to discuss, by all means, any other aspects of A Steward's View, visit us online, or you can email team@astewardsview.com. That's team@astewardsview.com. You can also find our social media pages, Instagram, TikTok, and YouTube. Lucian, so yay. And then that's going to be in the footer of the astewardsview.com website. So that's it. That's what I've got for today. I think we've covered a lot of ground. I love this. It's a joy to be back. I hope this session has been a blessing to you and others you decide to share it with. And that's from all of us here at ASV. We're looking forward to what's ahead. In weeks coming, we're going to do more along the lines of integrating investments and planning. Those are conversations we had a lot last year. And so you'll kind of notice as time goes on, we'll do something with economics like we did today, look at the big picture, and then we'll kind of drill down into investment and planning, in succession. And we'll also make sure to add an ASV Plus in there. So I know Lucian has an applause button over there somewhere. He's at least hitting it in his head. But yeah, that'll be what's coming up in weeks ahead. As far as the ASV Plus, I don't have the exact timing for that yet, but we try to do that once a month as well. So that's what we've got for today. Until we get together again, let's reconnect at astewardsview.com. Thank you for joining. Please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.